Hello, I am pleased to present the Retirement Benefits Workshop that was originally presented on December 13th, 2018 at Les Paul Middle School. This presentation will cover two important areas that may impact your retirement benefits. The first section will discuss the benefits from the Wisconsin retirement system, and the second section will cover the district benefits that are provided to eligible members of the Teacher Employment Group of the School District of Waukesha. If you are an employee member of another employment group, please contact the Human Resources Department to make an appointment to receive information on your own district benefit. As we begin this section covering the Wisconsin retirement system, it's important that you understand that I am not a WRS employee. I am providing you information to the best of my knowledge and should not be relied upon as advice. This is general information, and you should always contact WRS for information specific to your individual situation. Now, the WRS covers hundreds of thousands of Wisconsin public employees, not only school personnel, but other state and government personnel as well. I'm going to be speaking about school personnel only in this video. The Wisconsin retirement system has approximately $104 billion in assets, and Wisconsin's is the best funded retirement system in the nation. The WRS paid out over $5 billion in benefits in 2017, which includes retirement benefits, death, separation, and disability benefits. Each year, you should receive a statement from the WRS that gives you important information about your benefits. Please read and verify the information because it relies on the input of human beings, and humans can and do make mistakes. Start looking at the earnings and the years of service box, and then keep going. You can check out your own statement, which you would have received in the spring of 2018 for the 2017 earnings and years of service. Alternatively, you can search for a sample statement on WRS website, which is etf.wi.gov. Your account grows year after year based on the following: required contributions from the employer and the employee. In January 19, the required contribution amount is 6.55% of income for each, for a total contribution of 13.1%. That is 6.55% of your monthly gross income will be contributed to WRS, and the district will also contribute 6.55% of your monthly gross income to the WRS on your behalf. Your account also grows from the interest that is earned from the core and variable funds. In some cases, people make additional contributions directly to their WRS accounts. These additional contributions will also show up on your statement. Additional contributions are put into a separate retirement benefit in addition to your regular WRS account. Be sure to read more about this by viewing the Additional Contributions booklet on the ETF website. Our school district also offers employees the ability to contribute towards their retirement via 403B tax-sheltered annuity as well as private IRAs. These are not the same as an additional WRS account. You should decide which investment vehicle is best suited to you to provide a supplement to your pension benefit in retirement. If you terminate WRS employment before you have reached the minimum retirement age and want to cash out of your account, you will receive only the employee required contributions, which is only half of your account. You should decide. Your account will then be closed and you will pay federal and state taxes and probably penalties too. Please realize that you can leave your money with the employee trust funds until you reach the minimum retirement age and then take a regular retirement benefit, which includes both halves of your account. If you die as an active employee, the death benefit listed on your statement is payable to your beneficiary or beneficiaries, and includes all the money in your account. That is both the employer and the employee share. What makes you an active employee? This means that you would have been currently employed in a position covered under the WRS. If you die as an inactive employee, meaning you were not employed in a position covered by WRS and have not started your retirement benefit, then the death benefit payable to your beneficiary or beneficiaries is on the employee required half of your account. Now, a word about beneficiaries. WRS death benefits are paid according to the most recent beneficiary designation form on file with the ETF. So be aware, even if the form is outdated from an old WRS employer and not correct, if it is the most recent, it is still valid. Death benefits from ETF are not paid according to your will. You may list your estate as the beneficiary and then the executor pays out according to your will. Are you divorced? Have you updated the beneficiary form? Go to the ETF website to download a new beneficiary form to ensure your wishes are up to date. If there is no beneficiary form on file, or if all the beneficiaries are deceased, then the standard sequence applies. This slide provides you with the standard sequence. The Employee Trust Fund calculates your retirement benefit in two ways, a formula calculation and a money purchase calculation. You don't have to worry about which to choose because the ETF will ensure that you receive the higher benefit. A lump sum distribution is restricted only to those with small accounts. Otherwise, you can expect a lifetime monthly annuity. The formula calculation uses your final average monthly earnings, the number of years of creditable service, a formula multiplier, and an age reduction factor. These calculations altogether will equal your monthly retirement benefit. Note that the maximum benefit for education employees is no more than 70% of your final average monthly earnings. The other calculation is the money purchase calculation. This is rather straightforward as the calculation uses the money purchase balance, which you can find on your statement, and a calculation factor which is based on your age at retirement. There is no limit on how high your monthly annuity can be under the money purchase calculation, and there is no age reduction factor. There is no 70% limit and no variable excess or deficiency in the calculation. So compare the calculation on your statement, formula versus money purchase. You will always get the higher amount when you finally retire. When you retire, your WRS account is closed, so the death benefit now changes to the annuity option you selected. It is important to understand that the retirement benefits are paid to you for life. You cannot outlive it. Beyond that, there are a number of options for you to consider which will impact the amount of the annuity you will receive for life. Now, everyone gets these first three options. Annuitants life only means that the benefit will be received for as long as you live. When you die, the benefit ends and there is no payment made to any survivors. Life with 60 payment guarantees and life with 180 payment guarantees are payments that are still made for the rest of your life. But if you should die within 5 years or 15 years, whichever you've chosen, the remainder of the monthly payments will be paid to your beneficiaries. Now we add the named survivor options. A named survivor is most often your spouse or partner. These options pay the annuity for a lifetime plus the lifetime of the named survivor. The 75% continued to named survivor option is payable to you for life. When you die, your named survivor will receive 75% of your monthly payment for the rest of his or her life. If your named survivor dies before you, all payments stop upon your death. If your named survivor dies within the first 5 years that you are receiving your annuity increases to the for annuitants life only amount. You may not choose this option if your named survivor is more than 19 years younger than you and is not your spouse. Likewise, the 100% continued to named survivor is payable to you for life. When you die, your named survivor will receive the same monthly benefit that you did for the rest of his or her life. If your named survivor dies before you, all payments stop upon your death. If your named survivor dies within the first 5 years that you are receiving your annuity increases to the for annuitant's life only amount. You may not choose this option if your named survivor is more than 10 years younger than you and is not your spouse. Reduced at either death means this option is payable to you for life. When you or your named survivor dies, the remaining individual will receive 75% of the monthly amount for life. If your named survivor dies first and your annuity began on or after January 1st, 2002, your monthly payment will reduce by 25%, beginning with the payment for the month after your named survivor's death. You may not choose this option if your named survivor is more than 19 years younger than you and is not your spouse. 100% continued to the named survivor with 180 payment guarantee is a benefit that is payable to you for life. When you die, your named survivor will receive the same monthly benefit that you did for the rest of his or her life. If both you and your named survivor die before 180 payments have been made, the remainder of the 180 payments are made to the designated beneficiaries. You may not choose this option if your named survivor is more than 10 years younger than you and is not your spouse. This slide shows specific examples of how the monthly payment options differ, depending on what annuity option you choose. Note the accelerated options as well. Accelerated payments are intended to pay you the same amount from your Wisconsin Retirement System annuity alone before you turn age 62 as you would get from the WRS and Social Security together after you reach age 62. With an accelerated option, you would receive a temporary increase to your monthly WRS annuity payment until the month after you turn age 62. For example, if you turn age 62 in December, your January 1st check would be the last one with the temporary higher payment. At age 62, your WRS annuity payment would decrease because the temporary accelerated portion would end. Here is some important information about the difference between a beneficiary and a named survivor. A beneficiary is listed on the ETF beneficiary form and can be changed at any time. You can also have any number of beneficiaries listed. A beneficiary doesn't even have to be a person. It could be a charity, an estate, trust, school, or others. A beneficiary applies to accounts prior to retirement and any guaranteed payments after retirement. A named survivor is listed on the annuity application and only named at the time of retirement. A named survivor must be one specific person who can never be changed or removed from your annuity unless ordered by a judge due to a divorce. He or she is a co-owner of your annuity and continues your annuity for his or her life after you die in retirement. The named survivor's age factors into your annuity payments. Once retired, annuity payments are adjusted each May based on the investment results for the prior year. The change is not tied to the cost of living. It is tied to investment results. Now, some of you are in the core fund only and others are in the core fund and the variable fund. If you are in the core fund annuity only, your annuity is adjusted based on the core fund experience. Your monthly annuity will never drop below the original starting amount. The first year increase is prorated by the number of months you were retired in the previous year. For some of us, that will be just 6 months or so, from July to December. If you are in the core and variable fund annuity, your annuity is adjusted based on both the core fund and the variable fund investment results. There is no proration either. The full variable adjustment is made annually, regardless of the number of months you were retired in the previous year, and there is no limit on how high or low the variable amount may adjust. Only the core fund portion of your annuity is guaranteed not to drop below the original starting amount. If you are in the variable fund now and want to cancel, you may do so either before you retire or after you retire. But once you are out of the variable fund, you cannot get back in. Please be sure to note that cancellations always take effect on the January 1st after the ETF receives your canceling variable participation form. There are lots of considerations for timing of the variable fund cancellation, and I cannot go into all of them here, but you can read about it through the ETF homepage, Core and Variable Information. Did you know that your WRS annuities are taxable as ordinary income for federal and possibly state taxes? You may want to consider electing to have federal and Wisconsin tax withholdings from each check. ETF has a great calculator online to help you calculate the amount of taxes you want withheld. Sometimes people are interested in going back to work after beginning their WRS annuity. The good news is that there are no restrictions for going back to work for a non-WRS employer. But if you want to return to work for a WRS employer as a rehired annuitant, the WRS requires a good faith termination and a break in service. What does this mean? There is no agreement in place for future WRS employment on the termination date. And 2, there is a break in service, meaning you cannot return to work until the latest of the following: the 76th day after termination date, or the 76th day after your retirement application is received at ETF, or the day after your annuity effective date. If you go back to work for a WRS employer for more than 2/3 of full time, your annuity will be suspended. 2/3 of full time for school year and support staff employees is 880 hours per calendar year. Contact the Employee Trust Fund well in advance to request a retirement packet. Anyone over age 55 may request a packet up to 1 time per year. Then, when you're ready to retire, complete the retirement application form and send it to WRS no more than 90 days prior to your retirement date. There are many resources on the ETF website, and links are provided in the retirement packet. Be sure to check out these resources as well. This concludes the WRS portion of this presentation. The remainder of the presentation will focus on the retirement benefit provided by the School District of Waukesha for the employees of the teacher group. Please note that the district reserves the right to change the benefit at any time. Which leads me to this first slide. What will the School District of Waukesha benefit look like after June 30th, 2019? This is a fairly common question and one I have been receiving and fielding for the past 8 years. The reality is we just don't know what the future of the retirement benefit will be. I can share that we have not engaged in any discussions with the Waukesha School Board about any changes. Furthermore, we would anticipate any change to the retirement plan would incorporate some type of phase-in that would address the people that are already eligible for retirement and those that are not. The bottom line is this: if you do not want to retire this year, then you should not. If there is a change in the benefit for next year and that change is communicated after the retirement deadline dates has passed, we would consider opening the retirement window so you can make an informed decision. As of today, December 13th, 2018, I don't really see this happening. We provided a retirement packet for you to review, and page 3 provides guidance on how to determine whether you are financially ready for retirement. But the bottom line is, you are the only person that can decide whether or not you are physically, emotionally, and know in your soul that you are ready for retirement. The benefit that is available to eligible members of the Waukesha teacher group is this. In order to be eligible for the district benefit, the teacher must be at least age 55 with at least 15 years of full-time, continuous years of service as a teacher in Waukesha. The benefit includes up to $75,000 to pay for age reduction penalties for your pension if you are under age 57 and or have fewer than 30 years of service in WRS. You can also use it for the continuation of health insurance and or a cash payout in the amount of $750. You choose what the $75,000 will be used toward from the 3 options provided. You may choose any and all options. When you contact the Employee Trust Fund for a retirement packet, ask for the actuarial reduction calculation as well. Now, the ETF will calculate the amount it will cost to bring you to full retirement age, whether that is 1, 2, or more years. But I recommend that you request that they do another calculation for just 2 years, because that is the limit the district will pay from your $75,000 benefit. If you choose this benefit, the amount paid on your behalf will come from the $75,000. Anything remaining can be used towards health insurance or the cash payout of $750. Up to $75,000 may be used to pay the employer's portion of the insurance premium. This means that you are still responsible for the employee's portion of the insurance premium. You will complete an automatic withdrawal form for the monthly amounts when you attend a retirement meeting with Kay Oldenburg in May. Kay is our benefits coordinator. To give you an idea of the cost of insurance, the family insurance cost for the employer's portion of the premium is about $19,000 per year. The single insurance cost is about $8,400 per year. These amounts are subject to change from year to year, and if you and or your spouse is on Medicare, the amounts are lower. You will receive the exact amounts at the retirement meeting with Kay in May. When the $75,000 has been spent, the benefit will end, and if the $75,000 is not spent within 8 years, the remainder will be forfeited. Now, we have all been blessed to receive a nicely funded health savings account from the district, but IRS regulations do not allow an employer to make HSA contributions for retirees. Therefore, the district will provide you with similar insurance plan that does not impact your annual out-of-pocket risk. The current plan is HSA qualified, and retirees may choose to contribute to their HSA on their own, but the district cannot contribute. The comparable plan for retirees carries a deductible of $1,300 for single and $2,600 for family, which is the same as active employees with the HSA. If you are someone that maximizes HSA contributions, you may want to recalculate those contributions for January through August of 2019. The single limit is $3,500 plus $1,000 catch-up for those over 55 for a total of $4,500. The family limit is $8,000, which is $7,000 plus a $1,000 catch-up for those over 55. Remember that the district contribution in March must be figured in when calculating the maximum contributions. Each year we receive some questions that are a little complex, and I'm providing you with examples of these questions here. Number 1, my spouse is a retired School District of Waukesha employee currently receiving benefits. Can I defer my benefit until the other runs out? The answer is yes, but the clock starts ticking when you retire. If your benefit has not run out after 8 years, you will forfeit any remaining funds. Number 2, My spouse is retired from another organization and currently receives benefits. Can I defer my benefit until the other runs out? The answer there is no. If at any time you discontinue the School District of Waukesha health insurance, you cannot re-enroll. Number 3, I need family insurance now, but can I switch to single later? The answer is yes. As a retiree, you can switch from family to single. However, you may not switch from single to family. There are some other benefits for people that do not meet eligibility for the full Waukesha teacher retirement benefit. For example, if you are age 55 and have at least 10 years of continuous full-time years of service with Waukesha, but less than 15, you may stay on the health plan if you would like to, but you would need to make the necessary premium payments directly to the carrier. If you have less than 10 years, you may not stay on the plan except as allowed under COBRA. If you are interested in continuing in the district benefit and you're 65 or over, you may remain in the group plan by paying the Medicare carve-out rate directly to the carrier. Dental and vision insurance ends for all retirees as of August 31st. You may remain in the group plan under COBRA. Life insurance and long-term and short-term disability ends for retirees on the last day of work. In order to preserve your right to the district retirement benefits, you must notify the district of your intent to retire in writing no later than February 15th. You are responsible for obtaining the actual reduction form and getting it to HR for signature before your last day of work. Do not rely on the school district to remind you of your eligibility. Remember, we want you to retire happy, so remember these timelines. If you haven't already done so, request your retirement packet from ETF now and send your letter of retirement to the school district no later than February 15th. Send in your retirement application to Employee Trust Funds no more than 90 days in advance. Usually that's around spring break. Attend the district retirement meeting in May. That date will be provided to you in the retirement letter you will receive after the board approves your retirement. And then get your actuarial reduction form to the HR department no later than May 31st. Please let us know if you have any questions and feel free to schedule an appointment with Chris Hedstrom for individualized assistance. You can contact Suzanne Pulaski at 262-970-1033 and she will set up an appointment. Thank you for watching this video. My best to you in your retirement.